Okay, guys, we're going to go to Ask Scruff. Now, this one's for Chris. It's a salute to you. It's an interesting question, but it's not as difficult as you think. Now, let me show you the question and we'll understand it. Need a little help to get out of the mindset that a market is overbought. I can't for the life of me get this idea out of my head. The market's all-time high, keeps going up without showing any signs of slowdown or even doing a small pullback to allow an entry. How can I overcome this mental block and just go with the trend? Okay. The first element of this is actually understanding how indicators work. Now, when you're talking about overbought, oversold, that's a bonded indicator. It's trapped between 0 and 100. Okay. They're perfect for sideways markets. They'll always show you where it's going up, going down, one thing and another. Okay. In this scenario you're talking about, you really need to be looking at a different type of indicator. In this case, a MACD, moving averages are far better. Even a Heikin-Ashi candle setup would be better. So you've got to be able to recognize the conditions. Now, you follow me, you know what I do. I trade through 3-click. So I look at multiple time frames. I also look at multiple indicators that do different things, but ultimately I'm looking at the chart itself, and that's where you see me do countbacks on candles, etc. So to get out of the mindset is stop looking at a single tool, because that's all an indicator is. It's a tool in the bag. But if you're going to cut a circle in a glass pane, you don't use a hammer, you use a glass cutter. So you've got to have the right tool for the right job. And in these scenarios, your MACDs and your moving averages are better, but just use the lower time frames for overbought, oversold to help time it that little bit by allowing it to relax there. But if you're waiting on hourlies and dailies, it could stay there for a very, very long period of time. And especially if the market is going like that. And I'm assuming you're talking about the likes of gold and the indices that have shown no signs of coming back. And this, again, it comes down to why you look at multiple time frames and the right tool for the job. Because if you're going down the route of like the fair value gap, every single one of them's wrecked. Every one of them. Because the market doesn't come back and fill it. What you need to do is just apply your knowledge and look through multiple time frames. Right, my monthly, my weekly, my daily, what are they up to? My daily, my hourlies, what are they up to? Are they all moving up? Yes. Right, well, that's your direction. Put it on a 5-minute chart and then just look for an entry point. Be a level, it can be a moving average, it can be a bounce off a fib, it can be the break of a structure, anything. But ultimately, it's right tool for the job. And in a trending market, an RSI or any bonded market or any bonded indicator is worse than useless. It's just a guide on the low time frames, but it won't do anything for you. So there you go. We'll touch on that more in the squad. And as always, keep trucking, kid. Lovely to speak to you. Catch you on the next one.